About 2 weeks ago, there was an article that appeared in the Wall Street Journal titled, "Can Dividend Investing Rise from the Dead?" which I thought was pretty interesting. It says, the once-blockbuster strategy of picking high payers has been battered by growth-focused tech titans. In the article, the author discusses several reasons why investors have been less interested in dividends nowadays compared to decades ago. And considering the fact we're in the age of Wall Street bets, cryptocurrency, and artificial intelligence, I definitely do think that there has been a decrease in interest. Which is too bad because, as I'll go into later, dividends have been responsible for the majority of the earnings from the S&P 500 over time. So let's take a look at some of the main points from this article. It says, these days artificial intelligence, sustainable funds, and quant investing are all the rage, while one of the oldest and simplest stock-picking strategies seems antiquated. Historically, when it comes to investing in the stock market, individual investors used to place a much higher priority on stable companies. Stocks like Coca-Cola, National Fuel Gas Company, and PPG Industries were stocks that investors loved and highly respected. Although they can be considered boring, as long as investors regularly bought shares of these kinds of stocks through dollar cost averaging, and as long as you were well diversified, you were almost certain to make really good money over time. This is what investing in the stock market used to look like for the vast majority of investors. What's more is that these kinds of durable stocks are known for paying high amounts of dividends to shareholders. One reason a company pays dividends in the first place is to show investors that they have strong financials. In order to pay a dividend, a company has to not only be making a good amount of profit, but they have to have enough money left over to reward investors for believing in their stock. So historically, the majority of companies in the S&P 500 actually used to pay really good dividends. But sometime in the 90s, and especially picking up towards the end of that decade, investor sentiment appeared to change pretty rapidly. The love for stable, cash-paying dividend stocks began to turn cold among investors who instead fell in love with high-tech growth stocks. Before the dot-com bubble took place, investors realized they could potentially double their money in just a few months as opposed to waiting a few years for their dividend stocks. Following this trend, companies got the message that fast growth was what investors wanted. And so many companies no longer prioritize paying a high dividend. This chart from the article shows what the average dividend yield used to be for all stocks in the S&P 500. You can see throughout history the average dividend yield of stocks in the market has changed from decade to decade, but it's obvious that the average yield used to be significantly higher than it is today. It's almost inconceivable to think that at one point the average yield of an S&P 500 stock was over 13%. But in all honesty, this was probably due to a temporary stock market fall, as it was very brief. If you look though, even in the 70s and early 80s, the average yield was often over 6%, which is significantly more appealing. But then in the 90s, yields continued to go down, and after the dot-com crash, dividend yields have never recovered. What's made dividends even less appealing is that there's so many options out there that exist besides dividend stocks. If someone's trying to live off dividends, why would someone settle for a 2% yield when they can get more than twice that amount from a high-yield savings account? Ally, for example, which has been my favorite bank for emergency savings for years, now offers a 4.35% yield on money that's FDIC insured. Then there's also CDs and money market accounts that offer much higher yields and are often safer or insured against losses. The biggest argument made in this article, in my opinion, is that investors aren't drawn to dividend stocks anymore because they don't offer good yields. Dividend investing is like the ultimate form of passive income. After you buy shares, you get paid every month or every quarter. And so even though a lot of people don't pursue dividend investing anymore, I really do believe that a lot more people would if yields were much higher like they used to be. People know that if you wanted to collect even a reasonable amount of dividends from a stock like CSX Corporation with its 1.3% yield, we're talking hundreds of thousands of dollars that would need to be invested in order to feel even a little bit of benefit from it. But there is some good news in this article though. In the last decade, fund managers have started to realize that people actually do want higher yielding investments. This chart shows the number of new investment funds that have been created in the last decade that shows that high income funds have been the most popular. At the same time though, the author makes a valid point where he says, that doesn't mean investors should simply look for stocks with the highest dividend yields. These are often low quality companies with unsustainable payouts. It's a true statement that investors who seek high income shouldn't automatically invest in what's offering the highest dividend yield. There's plenty of mortgage REITs, closed-end funds, and synthetic covered call ETFs that exist that offer outrageous yields. But looking at their dividend histories, you'll see that they consistently pay fewer and fewer dividends over time. What's considered too high varies from person to person and also what kind of company or investment you're looking at. I'd personally say that any investment yielding more than 12 to 15% would be considered very questionable in terms of safety. Speaking for myself, I became interested in higher dividend paying investments all the way back in my early 20s. Like so many of my peers at the time, after graduating college and working in the investment world, we were all wanting to build wealth by investing in stocks and at the time mutual funds. All of my coworkers were drawn into tech stocks or whatever was being hyped on CNBC, but I was the only one drawn to dividend holdings. I loved the idea of building up a large enough portfolio to where I could eventually live off my dividend distributions. Whether that entailed retiring early or just having emergency cash coming in, I wasn't too sure at the time. But just like most investors, I saw that it would take millions of dollars to live off dividends from a typical dividend-paying holding in the S&P 500, which initially was very discouraging. That's when I decided to dedicate my investing focus to researching higher-yielding investments. That's where I learned about all the higher-yielding options that exist that unfortunately don't get covered in books, on CNBC, or with younger crowds, social media. Investments like closed-end funds, master limited partnerships, and business development companies receive very little attention. But higher-yielding investments do exist, which is what I like to uncover and discuss on this channel. So while it is good news that investors are getting more high-yielding funds and ETFs to choose from, it's still unfortunate that most S&P stocks still don't pay decent dividends. And I think this is what turns most people away from seriously pursuing dividend investing nowadays. They look at the typical S&P 500 stock's dividend yield and they get turned off to the idea of being a dividend investor after seeing how low it yields, just like I was. The alternative investments that offer much higher yields do exist and should get more mainstream attention. And what most people don't know is that dividends are responsible for a huge part of the overall market returns. This chart shows the total return of the markets between the years 1960 and 2022 with and without taking dividends into consideration. You can see just how significant of a difference dividends make when you reinvest them over time. A $10,000 investment back in 1960 would leave you with $4 million with dividends being factored in, or just $641,000 without dividends. So you can see the benefit that comes from investing in dividend-paying holdings and remaining invested in them over decades. It creates what's referred to as a dividend snowball. This is what happens when you stay invested in a growing dividend stock over the course of a few years, where compounding interest is allowed to accumulate. Another benefit to dividend stocks is that dividend stocks still provide investors with returns when the market is flat. There's been whole decades where the market didn't see any significant share price growth in stocks, such as what happened during the 1970s. The so-called lost decade was a period where investors would put money in the market and they had no consistent growth with the exception of dividends. So what does the future hold for dividend investments? I think there have been some encouraging things going on, such as new high-yielding income funds being created. I can also tell here on YouTube that there has been more content being created that revolves around these higher-paying dividend investments. But it still seems unlikely that while this tech boom is currently going on with artificial intelligence, that people are going to be interested in dividend stocks anytime soon. It has been known that interest in dividend investing does tend to pick up after market crashes and bubbles pop, which is when people search the markets and try to find consistent paying investments. I also think that investors will probably continue to avoid some dividend holdings until some of the higher yielding asset classes recover once interest rates get cut. Right now that would include equity and mortgage REITs, as well as many closed-end funds that hold fixed debt. But although dividend investing isn't the most popular investing strategy anymore, it's definitely not dead. Only time will tell if pursuing dividends will someday return to its former glory like it was many decades ago. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.